Good morning. Good morning. Today's Thursday, February 27th. The time is 10:04 a.m. I'm going to call the Deferred Comp Advisory Committee meeting to order. Start off with roll call.
Yes, roll call. Ms. Goodman.
Here.
Mr. Whelan.
Present.
Mr. Gardia.
Present.
Ms. Regallo.
Here.
Mr. Wilkamp.
Here.
And for the record, we will show that Ms. Herman and Mr. Keokum are not here. Thank you.
Thank you. First item on the agenda is approval of the minutes from the quarterly meeting held on October 24th, 2024. Any questions from the advisory committee on the minutes? So it looks like the minutes are not in our printed packet for today, so I'll ask staff to go and get this, and we'll move that to a little bit later in the agenda so that we have a chance for the advisory committee members to review those before we take that action. All right. Next on the agenda is public comment.
No public comment at this time.
All right. Then if Nationwide is ready, we'll move on to our program status report for the fourth quarter of 24.
Thank you, and good morning. So we'll start with the very colorful blue and white report, and thank you for printing this. And we'll start with the second page. This is just the balance sheet. of all of the plans, the 457, the 401A, and the total. So the top line is where the quarter started. It seems like a long time ago, but September 30th. So the plan had $608 million in assets. Then the plan received $7.3 million in contributions for the quarter. You can see less distributions, which are typically higher in the fourth quarter because of RMDs and so forth. Then you subtract fees and loans and you add other activity, and then you can see that gain-loss line. So for the first time in a while, there was negative market activity. So we're used to seeing positive market activity, but the fourth quarter was the opposite. So the quarter finished at $605 million right at the end of the year. So then we move into just the 457. So that was a balance sheet for all plans. So we moved to the 457, and that's on page 4. So again, we have the same balance sheet. So we're going to skip ahead to page 6. And page 6 just talks about participation. And on the upper left, you have the total participants in your plan of 7,428. Right below that is your average participant balance. That's simply all the assets in the 457 plan divided by that 7,428. And then if you look at the pie chart, kind of in the middle of the page, that's just a look at your assets, whether they're held by employed participants or terminated participants. And so it's roughly a 52 to 46% ratio. So just over half of the assets in the plan are held by participants that are currently working for the county. So we want to keep an eye on rollover activity out of the plan because there are a lot of assets subject to be able to leave the plan. Because once you separate service from the county, you can take your money. And so we're aware of that. So again, we want to focus our efforts on conservation. And then on the very right-hand side of the page is Roth usage. We track Roth separately because Roth is a separate money type from pre-tax. So Roth is after tax, and the record kept separately. So we have 1,215 participants that have selected the after-tax money type to invest in. Then on the next page 7, we continue with optional strategies. We've already looked at Roth. And we also have self-directed brokerage. We have a separate report for that we'll talk about just in a couple of minutes. But your self-directed brokerage account, it's a little gray box. You have a higher average account balance there than you do in your plan in general. So you have 12 participants that have selected to move money out of the core funds and enroll in Schwab and move it into self-directed, which is an opportunity that they have here with the plan. And then again, the average balance in their Schwab accounts is $165. And then we'll take a look later at what they're investing in. For cash flow on the next page, page 8, if you look right in the middle of the page, we have current quarter, and this is all of the various parts of cash flow that Nationwide receives from county participants. So the top line is salary contributions of $5.5 million. So for the quarter, we received that much in contributions or paycheck deferrals coming into Nationwide. We also got some rollovers and transfers in, self-directed brokerage, money flowed in. Account splits, that's typically a quadro divorce decree, and then employer contributions for a total of $7 million for the quarter. So a little bit less than the quarter prior, but still a pretty solid quarter for contributions. If you look at that little wheel chart and then the data next to it, that tells you where money is flowing into Nationwide from new contributions and what investments your participants are selecting to invest with new money. So the asset allocation row at 52% means that 52 cents on every dollar Nationwide receives is going into a target date fund for new contributions. And you can see the rest of the numbers, bonds, fixed assets and cash. That is the preservation of principal option where it doesn't have any risk. So about 12 cents on every new dollar is going into something guaranteed, whereas the rest of it is going into the market. And the other, I guess, category that your participants like is large cap mutual funds, pretty common with most retirement plans. So we looked at money in. We'll take a quick look at money out for distribution activity. Again, in the middle of the page, the current quarter, we had over $6.5 million in rollovers out of the plan. So again, these participants separated from service. They elected to move their money from Nationwide out to another record keeper or a different type of product elsewhere, which again, they can do when they separate service. The very bottom has the top 5 external payees. So if you're wondering, well, where does the money go when they roll it out? This is a snapshot of the top 5. And so you can see the names and then the amounts of the rollovers to those top 5 vendors and then the total amount. So out of the 6.5, 5.8 went to 5 companies. And so again, we track all of it, but only have room to list 5 on the report. We also had a lot of money in RMDs. RMDs are required minimum distributions. Most participants take that in the fourth quarter of the plan year because they hadn't yet. So they realize, oops, they better take it before the year ends. And so it's fairly common to take that in the fourth quarter. So RMDs were 2.2 million. You can see that in the prior quarter was only 386,000. So it's a much higher number in the fourth quarter than it was in the quarter prior. So most of the rollouts were rollouts out of the plan and RMDs for the quarter. And then we also had some, the third line is retirement. That's a real generic line item just to say that they took the money in cash. And so those are just simple withdrawals. So any questions about cash flow in or cash flow out of the plan?
Go back, I had a question. Can we go back, I have a question here on page, or is it time for questions, or do you want to go on? I don't care.
Please.
Okay, so page 6, we've been watching this ratio of terminated, separated from the county in retirement, and then employed, you know, being about half. Do we have a metric on other counties or other cities, large scale plans of our size? Do we know the ratio of what they're at compared to what we are?
Yeah, we work with a lot of counties in California and many of the same size as San Joaquin. Yours is probably, you probably have more terminated assets, I'd say, than the average county. We see a lot of kind of this 60-40 range. So you're a little higher than that, but it's not alarming because of the aging population. And it just depends on which county you work for, really. I don't know if you have any comments, Brenda.
No, that sounds accurate.
Okay. Yeah.
Yeah, I comment on that. Actually, a bigger slice of that green is probably better because the attractiveness of the plan is drawing people to stay. So weirdly enough, you kind of want the big balances to stay in the plan. So I think it actually shows pretty well, even though it's in somewhat of an outlier.
Yeah.
Thank you.
Then we'll move along to page 10. Just have a couple pages to go. Page 10, if you look in the upper left, that just it says assets and allocation, and there's a little chart there, and it talks about. So we looked at money flowing into the plan, and this is where existing assets are. Again, on page 10 on the upper left. So 52% of every new dollar is going into a target date fund. Well, 22% of your assets are currently in a target date fund now, and then you can see the other percentages below it. So you have about 25% in fixed assets. Again, that doesn't have any risk, it's guaranteed. And then large cap funds make up 36% of the total assets Nationwide record keeps. And then on the next couple pages, we list every single investment option in your plan with assets. We also list how many participants are in each fund. It's really good to know when there's a fund change happening or if there's a fund being eliminated. So it's good to have that data. So I won't really go through that, but it just, again, shows all of your investments and what your participants own. Then on page 13 is just a loan snapshot. So you have 368 active loans currently. So 368 of your employees have taken a loan through Nationwide. You see the loan balance. And then last quarter, we had 57 new loans paid and closed 15. So loans are growing a bit, but if you look at the very upper right, it says current average loan balance of $9,300. Your participants can borrow up to half their balance, up to $50,000 for loans, but your participants are borrowing less than $10,000 on average. So the loans are not very big, but they are growing slightly, but it's really nothing to be concerned about, I don't think. And then just wrapping up on page 14, this is a new page that we've recently created. It's just a stat about online engagement and enablement, and it just shows our e-delivery statistics. So e-delivery these are folks that have opted out of getting paper, whether it's statements or fund change notifications, they're fully online. Online accounts, 64% of the participants have an online account. That number is growing thanks to Brenda's efforts. Online distributions, your participants can take money out online or they can fill out the form the traditional way. So 77% of distributions that Nationwide receives are done online. And then on the upper right, beneficiaries, pretty good number, 90% are on file with us. Our statements list who the beneficiary is, and if there isn't a beneficiary, we'll let them know. It'll say no beneficiary on file. That just means with us. They might have one here. Emails, 91% of emails we have on file. A lot of our marketing is done through email, so the higher number, the better. So 91% is a very solid number for emails. So we definitely like to see that. And then online enrollment, fairly new also, but your participants can enroll either online or through the traditional forms or paper method with Brenda. And so about 1 out of 4 enrollments is being done online currently. And then the two stats at the bottom, so My Income and Retirement Planner, that's the software that Nationwide offers through our website. If a participant goes to the software, then it rolls up to the committee level, and then we let you know how many participants have used the software. And then My Investment Planner, that is free online advice that Nationwide offers. If your participants don't know how to invest, they can go to what's called My Investment Planner, and we will give them advice. It's point-in-time, one-time advice, and then they can take that advice, and then they can update their investments. And so they would need to use that quite often, though, to keep it up. Yeah. Comments, sir?
Yeah.
And then I'm going to wrap up with the 401A plan, just on page 17. This is just the overview. We have all the same data points as the 457. The overview just has a snapshot of everything. So 32 million in your 401A plan, 2 new enrollments in the fourth quarter. You can see cash flow in and cash flow out, so cash flow positive in your 401A. 145 participants have a balance in that particular plan. You can see the average balance is fairly high, so 222,000 in your 401A plan. And then no rollovers in for the quarter, but we did have some rollovers and transfers out for the fourth quarter. So going to pause. I know that we threw a lot of numbers out, but are there any questions about any of the Nationwide data? Again, your plan is very strong, very solid, good diversification. Your participants are contributing. They're well diversified. So.
Any questions from the advisory committee members?
Yeah. And then I'll turn it over to Brenda for some comments and updates here locally from the field.
Thank you, John. All right, so it's been busy, which is fun. We had our quarter 4. Our team does webinars for basically here in Northern California, and I would have to say San Joaquin County's attendance was the highest I've ever seen. Your team did a fantastic job pushing out the invitation to employees. So we averaged, on the low end, we had around 40 in attendance. On the high end, we had like in the low 60s. So definitely higher than average. So we really appreciate your efforts getting the invitation out to everybody so they can get that education that we have to offer. Also, it's an ongoing effort for me to kind of get out to the different departments. I'm not new to the county, but I'm kind of new back in this role with Nationwide. So just been working on making contacts. I reached out to Patricia Lord and went out to Department of Agriculture. That was a great day. We did a group presentation, just kind of like a lunch and learn, kind of people could bring in their brown bag, and I just did a retirement 101 for a group of about 10 people there, and then we did one-on-one appointments, and so definitely going to be going back there. And then this week I'm visiting probation, which is awesome. I went to juvenile probation earlier this week and was pretty busy, and I think once people knew I was there, I had people standing at the door to see me. And then this afternoon, I have the privilege of going over to adult probation. So just really continuing to work to make those department contacts and get in to see the staff and let them know about all the great provisions that are available in the plan, especially for public safety here. And so that's just going to be an ongoing effort for me.
Thanks for coming out to the sheriff's office recently. We appreciate it.
Yes, I'm always busy there. Thank you, guys.
That was going to be my question, is if you've visited the sheriff's department lately, so. Perfect.
And she's been great too. When after we do a presentation, people will come by and say, "Oh, I heard you talking briefing," and then we can call Brenda if they have a question, and then, "Hey, take your phone, go in this room, close the door," because they're going to give private info. But she's able to get people dialed in, and we did that twice in one day recently.
Thank you. Any other questions about the first part of our agenda, the quarterly plan review. All right. So wanted to introduce Eric Galinsky. Eric is a fellow nationwider from Alabama, right? Yes,
Went to school in Alabama.
went to school.
but- Yeah, but I live in Wisconsin.
Excellent. So Eric is a product expert, and last quarter we discussed an in-plan guarantee product called Retirement Income Builder. And then in prior quarters, we've also discussed a couple of other products Nationwide has. So we wanted to bring best practices to the committee and let you know about some new products that are offered through Nationwide. So we do have a handout. Again, we just wanted to refresh the committee about about a product we have called Retirement Income Builder. So Eric's going to walk you through that again and take any questions that you have. But again, we wanted to bring this forward just for your awareness and your consideration.
Yeah, thanks, John. So hi, everyone. Great to be with you. So I think you all have the packet. Yeah, it looks like that. Great packet. Excellent. So we'll kind of be walking through that. I would say to start off, what we have seen in the industry over the last few years is an emphasized focus on retention of assets. Because not just with your county, but really across the country, participants do a really good job saving for retirement. But when they get to retirement, they need additional help on how do they use that retirement savings to truly supplement what they're going to get from the pension and if they have a Social Security benefit. And very often, they'll take the money out of the plan, take it to a local advisor for that assistance, and very often an advisor is going to put them into something that creates a stream of lifetime income. So the industry as a whole said, okay, well, what if we started creating investments that can be added within a 457 or 401A that essentially do the same thing? So a person has the opportunity to turn their 457 or 401A savings into a stream of lifetime income, all while keeping the money within the plan. And so these solutions have gained a lot of popularity over the last few years. We have several thousand plans that have added a solution like this. And for your county, we think Retirement Income Builder is probably the best solution that makes sense. So I'll kind of be walking through it, and as I walk through it, please stop me if you have any questions.
Thank you.
So if you turn over to what I'll call page 1, which is the one with, looks like that has a graph on it. Retirement Income Builder is a series of target date funds that sits within a CIT. So I know you guys talked about CITs last time a little bit at your committee meeting, but essentially it's a series of target date funds. So it works very similar to the series you have now with the T. Rowe Price, where it's going to take an age-appropriate amount of risk based on your timeline until retirement. But what's different about it is that at age 47, it starts to look at your account balance. And every quarter, it captures what's called a high water mark. And so if your balance is higher at the end of this quarter than it was the quarter before, you lock that amount in as your high water mark. And we catch that high water mark between the ages of 47 and 65. So essentially, an individual will have 72 opportunities to capture their highest account balance possible quarterly for 18 years. Starting at 65, the participant then has the ability to start receiving income from the account. And they will receive 6% of that captured high water mark every year for the rest of their life. If their account balance ever gets exhausted down to 0, they still receive 4.5% of that high water mark for as long as they live. So if we look at this graph, this kind of just outlines everything that I just said, but I'm going to use some real numbers. So for this individual, their captured high water mark is $550,000. Before they turn 65, you can see with that sort of grayish part of the graph, there was a huge drop in the market. But they had already locked in their high water mark the quarter before that, so they weren't nearly as impacted by a sudden drop in the market right before they retired. So their high water mark captured is $550,000. They elect to start to receive income at 65. They will receive 6% of $550,000 every year for the rest of their life, which in this case is $33,000. So they essentially have turned their 457 or 401A savings into another stream of lifetime income that they can rely on and plan for. Now, in the chance that their account balance gets exhausted down to zero through these distributions, they still are gonna receive 4.5% of that high water mark, which again is 550,000. So in this case, they know for sure they will receive $24,750, even if their account balance gets exhausted down to zero. That's essentially how Retirement Income Builder works. It's pretty simple. Now, there are some details that I'll go over it as well and probably, hopefully answer some of the questions you're thinking. It is fully liquid, just like any other investment in the plan. So if you have a participant that goes into this, decides for whatever reason they want to get out of it, they exchange out of it into any other investment in the plan. There is no issue with that whatsoever. It is fully liquid. Secondly, it works similar to any other investment. If they were to pass away, to the penny, whatever remains in their account gets passed on to whomever they have stated as their beneficiary. So that works just like any other investment in the plan. But also on that note, this option has a joint life feature. So a participant can decide, well, not only do I want to receive guaranteed lifetime on my life, lifetime income on my life, I also want to receive it on my spouse's life. They can set that up as well. So if you turn to what I'll call page 2, which is just the next page past the graph, at the very bottom, it outlines that joint income option. So if their spouse has an age difference of more than or less than 10 years, they will receive 90% of what their benefit would have been. If their spouse has an age difference of more than 10 years, they'll receive 80% of what their benefit would have been. So they have that option to choose to receive income on their life and or their spouse's life as well. If you flip the page again, what I'll call page 4, this talks about the cost at the very bottom, participant fees. So depending on what vintage of target date fund they're in, it depends on what the cost of that fund is. So younger folks, if they go into something like this where it's gonna work very similar to a target date fund and before those high water marks start, they pay 9 basis points, which is 0.09%, which is very, very comparable to the other expenses in the funds that you have now. For those older individuals and who are starting to receive the benefit of that high water mark, they pay a little bit more, which is 20 basis points or 0.20%. And so those are the costs associated with it from a fund perspective. This solution is completely portable as well. So if, and we obviously hope this never happens, but if the county were to ever leave Nationwide, this solution can transfer over to your next record keeper as long as they've made it available, and we maintain all the same guarantees and high water marks that those participants captured while within the Nationwide record keeping system. And so even though the solution generates 6% income, the employee retains full control on how, when, or even if they actually receive the income. So they can start to receive it as early as 65, but they get to decide when they actually take the money out of the account as a distribution. They decide how much they take out, and they also decide what frequency. So we talked about that example with $33,000. That's the annual amount. If you want somebody to receive that on a monthly basis, they can set that up. So they still retain full control on how the actual distributions out of the account happen. So very often we'll get asked, it sounds a lot like an annuity. How does it compare? And it is an annuity in the sense that it creates lifetime income, but it is very different than, say, a retail annuity that one of your participants may go out and buy outside of the plan. One, the cost. The average retail annuity is about 2.7-ish%, whereas this is either 9 or 20 basis points, so pretty significant. Another thing is I talked about earlier, if they were to pass away, all of the money that remains in their account gets passed on to whomever they have as their beneficiary. Very often in a retail annuity space, depending on the type of annuity, the person gives up that type of control and that ability to pass on money to beneficiaries. With something like this within your plan, they don't lose the ability to do that. whatsoever. So I think it's a good time to pause and just see if there's any questions. So whenever there's no questions, I always say that means I did a really good job explaining or a really poor job explaining it. And so hopefully,
I do have a question, sir,
Yes.
if you don't mind.
Excellent,
So, okay, so I see, we'll say it's the 6% for the argument's sake on that. So you get 6%. What if are you choosing the allocation then, or are the participants still choosing it? How does that work? And then do you retain anything above 6% that comes out? I'm not quite sure, other than the basis points, how this is feasible.
yeah, it's a great question. So keep in mind that it is a target date fund. So let's say you're a 52-year-old individual, you decide to invest in this, you're put into the appropriate vintage based on your year of birth. That target date fund is managed by a company called State Street. They're a big name in the industry. So they're actually the ones that are managing the target date fund and the investments within that. So you essentially have the same growth potential through that target date fund as you could in any other target date fund. And so as you every quarter that goes by, as you have a balance in retirement income builder, you lock in those high watermarks, which is essentially your account value. The 6% is essentially just your payout percent. So it's a payout percent of that captured high account value. So 6% is the targeted amount, but it can absolutely be higher. So based on how the performance is over the time that you're invested in retirement income builder, you could have a higher than 6% payout percent. But don't forget that the 6% is not the rate of return that you earn. The 6% is clearly just the payout percent. The rate of return is based on how the investments perform along the way. And I think that the other part of your question is, we mentioned how is it feasible? I guess I'm assuming you mean how is it feasible for Nationwide to offer something like that? So
Correct.
part of that 9 or 20 basis points that is built in, we are an insurer, one of 2 insurers on this product. So we basically, it's our responsibility to cover that 4.5% if an account is ever exhausted. So part of that 9 or 20 basis points does get paid to the insurers within the product, Nationwide being one of them.
Okay, so it starts off at age 65 with 550,000. You got the guys and gals at State Street are rock stars. It goes to 1.5 million before they hit their 95th birthday. They're guaranteed at 6% of that original amount, which is the high watermark when they retired. And we'll say it was at 550, right? So even though it's gangbusters, it's worth 1.5 at age 90. They're still getting 6% of the original, correct? And then what happens to that growth?
So the growth stays in the account. So you're exactly right. So once income activates, the high water marks stop. So they wouldn't continue to capture that beyond that point. But in that particular, and keep in mind that they'd be withdrawing 33,000. So the market or the fund would have to really perform well to keep growing to that extent. But it is possible. And then that's just remains in the participant's account, and they can do whatever they want with it. So if they want to take out excess withdrawal, they can. If they pass away with a remaining balance, it gets passed on to their beneficiaries. Absolutely. So they retain full control and liquidity of assets at any time, regardless of income activation or not.
And is the beneficiary locked into that, whatever the agreed upon distribution terms were, or can they take the balance and run?
They can take the balance and run. So if they don't choose the joint life option, so if they just pass away and it gets they can take the money and run just like they would with any other investment in the plan.
But choosing the joint option does lock them into.
Correct.
Okay.
Yep, and that's actually an irrevocable decision. So if they choose joint life, their spouse would then receive the same payment that they were receiving, essentially with that 80 or 90% reduction based on the spouse's age. That's exactly
I'm
right.
not wishing this on people, but death or divorce, what happens that if you lock it in? Oh, I locked it in on my wife. I married 20 years younger a year before I retired, and then death or divorce, what happens?
Yeah, so with death, essentially nothing. I mean, well, the spouse obviously is no longer a beneficiary of it, but that income percentage does not change for that individual. So that is a potential risk, and that's why, the age parameters of more than 10 years is factored into that as well. In a divorce situation, you can reconstruct the contract to take that person off the joint life option. If it's a QDIA situation, you can reconstruct it. So if you essentially had set it up for them as the spouse, that legal status changes, that can be reconstructed.
So I have a question about, when we look at our participants, we see that most of our participants are a little bit on the older side. So is there any benefit for, I mean, is there any required point you have to have entered into this type of investment? And what would be the benefit for the older people?
Yes, great question. So actually, if you look on page 4, which is product basics page, the contribution restrictions section, to your point. So you do have to be in it, invested in it, at least a minimal amount of $1 essentially by the time you're age 61. So essentially anyone older than that wouldn't be eligible to invest in this and start capturing those high water marks. So I think it's designed for everyone, but it's most beneficial for those employees that are in that 47 to 61 age group.
And would the person, if they join before 61, but they retire before 65, and that, as long as they stay with Nationwide, would that work for them?
Yeah, absolutely. They still wouldn't be able to take the income out until 65, but absolutely, they could, there's no issue with that whatsoever. As long as they have their first contribution into the investment before 61, then they're good to go.
Okay. And then the joint distribution is only available for spouses, it's not for other beneficiaries?
Correct, correct. Great questions. So, if and when this is added as an investment, the way it appears to a participant, so they'll see, if they're interested in a target date fund, you have your T. Rowe Price series now, so they'll see all those vintages. And then for retirement income builder, they'll just see one investment. It says retirement income builder. So there's not confusion of having two target date funds. They just see it as, oh, that's the investment that creates that lifetime income. And then they are automatically put into the appropriate age vintage based on their year of birth.
And how long has this product been around? I'm sorry, you have your hand up? Oh, how long has this product been around? And then also, I see your fee structure, I think it's very competitive for an actively managed fund compared to some, other active management funds we have. However, what's their performance track record, or could we have that to see how they've been doing if they've been around a while?
Yeah, so these are actually passively managed, so they just invest in index funds, and that's one of the reasons why they are so inexpensive. State Street index funds have been around for a long time, and so these are essentially State Street target date funds. That's essentially what they are. They are the exact same for anyone older 47. For everyone over 47, they are a little bit different because a typical target date fund has an allocation into a fixed income sleeve, a more conservative type of investment. With retirement income builder, that fixed income is replaced by a different asset, an asset called a fixed index annuity, which actually reduces volatility a little bit. So State Street has found through their analysis that these solutions outperform their typical target date funds in a negative market because these are less volatile because of that inclusion of that different asset class over fixed income. Retirement income builder's been around for 2 years now. Nationwide's only offered it on our platform within the last 6 months. And we do have, there is a sister plan called Lifetime Income Builder. That's been around for over 5 years now. It works very similar. It's with more active management, but it doesn't have a joint life option, and it is a little bit more expensive. Great questions.
I got a question. So back to this chart, and I'm on the gray side, not the blue column side. The gap between the high water mark and the market value, back to your point about not so much portability outside, but maybe flexibility. Let's just say the high water mark for ease is 100,000, but that trough in that gap of the white space is 90,000. If I decide to move it to another fund, am I moving 100,000 or 90,000?
Great question. 90,000.
Okay.
So that trough, that gray line is the actual account balance. So you would move your account balance in that situation.
So the high water mark is only for annuitization or the income calculation?
Correct.
Okay,
Yep.
perfect, thank you.
Yep, yeah, it's a good point. So the high water mark is likely going to be different than the account balance at the time of income activation. And when, on that note, if the participant were to pass away, the money gets passed on to their beneficiary, they get the account balance, not the high water mark.
So then back to the question, before the annuitization, I could leave my kids or grandkids as beneficiaries because I haven't locked in yet. Once I lock in, it's spouse only, right? Or no?
For the joint life option, spouse only, but your beneficiary can be anybody.
Before I lock in, okay.
Correct,
Okay,
yes,
thank
yeah.
you.
And you can actually, I mean, the beneficiary can be changed at any time, just as it would with any other investment in the plan. Yeah, and the quarterly high water mark is designed to help protect against market volatility, and that's a great example. Hey, you have 100,000 and you're gonna retire and boom, huge drop in the market. Now you're looking at 90,000 right before you retire. You all probably have peers and coworkers that experience that. With this, if they're relying on a retirement income builder to generate that stream of lifetime income, they'd already locked in that high water mark at 100,000. So it protected them from seeing that significant drop and from their planning purposes in retirement.
Are there any drawbacks that participants would experience from an investment like this?
I personally, the only potential drawback would be because these are passively managed and your other target date fund series is actively managed, could they have performed better in an actively managed target date fund scenario? That's a very big if. A lot of active managers out there would say, you know, they would swear by that. But that would be a potential drawback, that maybe they could have seen better growth somewhere else. But I think for the type of investment, for the type of person that this is designed for, they're probably not someone who's trying to outperform the market anyway. So I don't know. I'd be curious to get Vince's take on that, if he sees any potential drawback to something like this.
Sure. I think the potential challenge, and I appreciate the portability, this was the biggest issue in the industry for a while, is these products specific to the record keeper, is when, through an RFP, that there's a change in record keeper. And so I think potentially, even though there's, I guess conceptually, the portability, sometimes there might not be, or it might be clunkier, or the new product, if you decide to move away from Nation, may not be as ideal. So I think that's a potential issue. Right now, it's fine, but if and when there is a change, could be an issue.
Yeah, there are currently 2 other major record keepers that offer this on their platform, and State Street mainly is constantly talking about other record keepers about adding it to their platform as well to really help with that portability conversation. Because like I mentioned earlier, it is designed to be portable, but the other record keeper needs to have it available on their system. That's where it is now, but I really believe in the next few years across the industry, because these are so popular everywhere, it is really going to truly be available on just about every record keeper system, because that whole portability aspect.
Sorry, and this is, I agree with you. The reality, though, is record keeper A might have their own version, record keeper B, and so there might be either, what do you call it, protecting their own turf to prevent it, or just a levelization across the industry and say, yes, we're gonna record keep other products like mutual funds. Fidelity will record keep T. Rowe Price will record keep Vanguard. So I think I would agree, but there's still, I mean, a lot of uncertainty, but yeah.
Yeah, it's a good point, Vince. Yeah, I think a lot of record keepers, they are creating their own version. But at the same time, they know this is important, so they are making these available. At the same time, they're creating their own version, almost just as like a plan sponsor choice. Hey, we have a suite for you to choose from. Do you want to go with this State Street product or this other product that we designed? So that, I think that's going to become very popular with record keepers.
So is there any option for, obviously the county has no intention to move away from Nationwide, but if they did, Or like if we were in this situation before we went to Nationwide, would Nationwide say, oh, you guys have this other product, we're gonna work to get that available to you? I mean, is that an option where, as part of the RFP process, you can kind of work so that the transition is easier for people, so they could go from, into the same product? I don't know if that made any sense.
Yeah.
By the way, Vince is looking to me, I think not, but.
Well,
Sorry, what?
No, I just said I don't think that made sense, the way you were looking at me.
made sense to me.
Okay.
I can let Vince answer it. I can answer from a Nationwide perspective. I mean, if you wanted to include it in an RFP, you absolutely could. Because these, again, are designed, it's just a really, there's a little bit of a build initially by the record keeper to add them. But I'm guessing if they wanted to win the county enough, that they would add it. And yes, we've had situations like that where we've assisted with that transition and making sure that everything transfers over. Yeah, absolutely.
Thank you.
And it did make sense. I'm just thinking about, we're going through the early stages of an RFP with another record keeper, not Nationwide. And so similar to self-directed brokerage or managed accounts, this would just be fully disclosed in the RFP. And in the few plans that I have it's not a lot of adoption. 2, maybe 8% of the assets roll into this product, but we disclose it, and then that's part of the RFP. And the questions and the answers is, look, we have $4.9 million in this product. What's your solution, record keepers A through J, on if you were to win, so it becomes part of the analysis. Not a big deal. Yeah.
Thank you.
So if I can just sort of share from a participant level where this really finds a home. Years ago, when I was running the Hartford office, I had a woman from the hospital, she had like $2 million, and her husband and his financial advisor were pressuring her, move your money, move your money. She didn't want to, but she did. Then she came back to me like a month ago in tears. I'm like, okay, what's going on? She goes, I didn't understand what happened to my money. It's in an annuity, and I can't get it. I was like, yeah, there's nothing I can do. So that was kind of unfortunate to see. Kind of like present day, people like me, I would love to have this in my 457 plan. 10 years of service, looking for other sources of income, public safety, who perhaps both spouses don't have Social Security. Just creating an additional guaranteed income source for them. My best friend works at the county hospital. By the time she finally retires, she'll have 10 years. She'll need an additional way to kind of turn her old 401k and her 457 into some lifetime income. So there's definitely a need, especially with spouses. I see people working longer because they're trying to get enough of a pension check to cover both people in the home. Oftentimes the other party is not in the government space. So there's just a lot of great application for this at the employee level.
And I can really see for our employees who are tier 2,
Yes.
their benefit is not going to be as generous as the tier 1, and they're
Right.
really going to have to have a different
Yeah,
form
and
of
it's a
savings to
decision.
support
It's
it.
just one investment in the portfolio. So if they want to have, some money here so that it guarantees them something, if they want to have some money in a different investment, that they can take out their money investment specific, but make sure they have that guaranteed income. Now they have a portfolio that gives the best of both worlds. It gives liquidity, but it also gives income.
So I think I have one more question. And it may be in here, so are participants able to say a certain amount of their balance, or is it their entire
Yes.
balance? Okay.
Yeah, no, whatever they want to put, if they have a high balance and they're like, I want to put 500,000 in this and leave the rest in a money market fund or something, or have it just full flexibility.
Okay.
Yeah.
Absolutely.
Great.
And I would say we see that very often with, say, law enforcement, where you may be retiring a lot younger than 65, where they'll say, okay, well, put half of my account potentially into this so that I know, hey, at 65, I have that stream of income, almost like a Social Security plan at that point.
Right.
But then they leave the other half into something else, giving them the flexibility to fill that gap. So absolutely.
I'm not interested in it for me, but as a fiduciary for, all of our county participants, I think it does really fill a gap like you're talking about. And so then you could have some deferred comp, your county pension, if you do get Social Security or not, and then just has another income stream. So I do see the benefits to our members in particular circumstances. And I think the fees are very impressive. I 0.09 I'm really excited about.
Yeah, I really feel like this gives people another reason to stay, right?
Absolutely.
The retention. They have a better deal here at home.
Yeah.
And just for planning, just from a planning perspective, to know what it's gonna be, because we all try to do our forecasts and stuff, and it depends on the market. Yeah, sure, I made, the S&P 500 was 30% last year, and that's great, but the next year it might be negative 25. But this way you would know, and so I think that's huge for people.
All right. Any other questions from the advisory committee? Is anybody ready to consider action?
I want to say thank you before any vote or motions, but because we brought it up, we had some concerns, it was brought up initially, and then I think Nationwide did a really good job of presenting this now. It was first a kernel of an idea, here you go, look at this, and then we had a lot more questions, and I think really delivered on answering them, so I appreciate the information.
Thank you, appreciate that.
I will just say, thank you, because this just gives us another option, it's there, and I do agree with Jason that it just, for those that don't have that, for planning purposes, that may not have that social security that it is, you can at least plan on that, and you're going to get that, so I do appreciate it. So with that, I will make a motion that what is it? The name, that we do, adopt the GTC Retirement Income Builder series in San Joaquin County.
I'd second.
All right. We have a motion and a second. All in favor, say aye.
Aye.
Opposed? Motion carries 5-0. Thank you. All right. Anything else from Nationwide?
I'll work with John on the appropriate paperwork, John and Vince. It is a typical fund change schedule, so, it's like a 2-month process typically. So once we have the paperwork in good order, then it would be available about 2 months following that date, just to kind of give you a timeline.
Thank you.
Who made that second? I heard it, but I didn't see it. Thank you.
And I just want to share the new webinar series that we're doing on March 6th. We're going to be talking about a couple of new investment options, one that's a sister product to this, just to give people a good overview, and another one that we have available that I have in some of my other plans, like San Joaquin Mosquito. So Eric is going to be working with Greg on my team to kind of talk about these new products, and this is all a result of the Secure Act and some, options so people can really secure their futures. So if you're just curious, that's coming up, and it's different than what we normally do.
Okay.
Yeah.
Great. Thank you. All right. We'll go ahead. Vincent?
All right. Thank you very much. My name is Vincent Galindo. The company I work for is called Highest Group. Similar to Nationwide, Highest Group is an outside partner, vendor, if you will. The one distinction, and I'm saying this because I just see a couple of new faces in the room, we adopt fiduciary status. And so essentially, even though the county is our client technically, the group of participants are really who we're advocating for, and all the recommendations that we make has to benefit those groups of participants, whether they're still employed here or not. If they have $1 or more in the plans, we're advocating for them, and so it's just an important distinction. And then I go through my report, just the difference. Speaking of differences, John and Nationwide team does a really good job talking about the plan, but more of the participant demographics. I focus a little bit more on the markets and the funds, but there is a lot of overlap, and so I will skip some of the pages in my report, not because they're unimportant, but because it's nice to follow John and his team. So I'm gonna report on the fourth quarter of '24. I also have the year numbers, but I also have some updated numbers because we're 6-7 weeks into 2025. And so I do have some updated numbers, and the nice thing is a lot of the numbers through 2025 are good. If they weren't, I wouldn't bring them up. But nonetheless, the last 3 months of '24 in large part was dominated by the election. Even though the election was in early November, thanks to polling as well as these new betting sites, I think there was a huge chance that there was going to be a change in administration, and that drove a lot of not only the news cycle, but what we're seeing in the market and the economy in the last quarter of '24. So flip ahead into the report on page 4. We did see a number of things, if you will, spike or rally strongly in the fourth quarter. Cryptocurrency rallied, especially with the promise of a new regime with the SEC. Bitcoin eclipsed $100,000 for the first time. We also saw a surge in the stock market, set new highs and continues to do so in 2025. We saw the 10-year Treasury spike from 3.7% yield to 4.5%. And we also saw, ironically, a significant rally in the US dollar. I say ironically because the new administration was campaigning around a weaker dollar, but we did see a significant rally in the greenback compared to foreign currencies. But if you take a look at page 4, I want to highlight a couple of the economic indicators just to set the stage of where we are from an economic standpoint. If you take a look at the chart on the upper left, gross domestic product or GDP, this is probably the best way of measuring our economic activity. Gross domestic product is a value of all the goods and services produced in the United States in any given year, and that's that solid line which corresponds to the left-hand vertical axis, hence the dollar signs. But most economists focus on that year-over-year change, which is represented by that lightly dotted line, and that's why the right-hand vertical column is expressed as a percentage. We as American consumers continue to be very resilient, meaning we're buying a lot of stuff. Consumers drive about 2/3 of the economy as measured by GDP, the other third, corporations and governments. But the Goldilocks economy is continuing. Goldilocks is not too hot, not too cold, rather just right, and that's about a 2 to 3% GDP number. Second quarter of '24 came in at 3.0, a little bit frothy. Third quarter at 3.1. Fourth quarter advanced number came in at 2.3%. So again, very, very healthy economy, and that is driven mostly because up until recently, most Americans felt really comfortable in their jobs, and wages continue to keep up with inflation. And speaking of which, as I pivot from left to right, we do track the unemployment rate. This is a measure of people who are out of work, actively looking, compared to the overall labor force. A measure of full employment is a 5% unemployment rate. We haven't seen a number that high in a few years. It was about 3.5, high threes, until recently it started ticking up to 4.0% at the latest read. Here in the county, it's a little bit higher at 6.5%. But again, nationally, we're generally comfortable. Given the new policies out of the new administration, there's a tremendous amount of uncertainty, especially with the governmental workers on the federal side. And so as that percolates through the economy, we'll see really what that unemployment number changes as '25 moves into '26, but still relatively healthy here recently. And then the one thing that's giving us pause is the consumer price index. CPI is the bottom right. This is but one measure of inflation. The Federal Reserve has an explicit target of 2%. If you remember a couple years ago, it was 9.1%. And so they aggressively raised rates to try and cool down the economy. And they did, but the latest read is 3.0%. And given the policies that I mentioned from the new administration around tariffs and about immigration, there were 3 interest rate cuts priced in the market, or at least the expectation of 3 interest rate decreases in '25. Now that's since evaporated to 1, maybe 2 in the summer. And so we'll see really what happens to interest rates as we move into 2026. The bond market. If you flip ahead to the next page, page 5, upper left, bond math states as rates go up, the value of existing bonds go down, and I talked about the 10-year Treasury moving from 3.7 to 4.5. Take a look on the upper left, the second line down, that Bloomberg US aggregate. Bond investors call that the AG. Historically averages 3.5% to the positive during a full market cycle. Take a look at the quarter, negative 3.1%. Not good for a conservative investor base who likes the steady return on the positive side of bonds. But nonetheless, that's what happens when interest rates go up. But the saying is what goes up comes down. The 10-year Treasury is now 4.25%. So year to date, as of yesterday, the AG is positive 2%. So a huge swing just in the first 7 weeks of 2025. Flip ahead to the stock market. I talked about the rally in the stock market continues. On the next page, page 6, the first line in the upper right is the S&P, or Standard & Poor's 500. These are 500 large US companies, typically household names like Microsoft, Nike, JP Morgan, et cetera. You can see for the 1 year, 25%. If you remember in '23, the S&P 500 was up over 20%, so nice back-to-back rallies in the stock market. Whether that happens this year to be seen. Year to date, as of yesterday, the S&P 500 flat to positive 1% here year to date. And I'm pausing intentionally because then we move into the international markets. There are about 45-ish countries outside the US with an investable stock market. I think a lot of people focus domestically on the US stock market. But on page 7, there is this all-country world index, which is the upper left first line. We call it the ACWI, ex-US. You can see for the quarter, negative 7.5%. The nice thing is the 1 year number is 5.5% to the positive. Driven mostly by the strengthening dollar, that negative number has since turned positive. The Bank of Japan raised interest rates, and so now our US dollar looks less attractive than to other foreign currencies. And so we have seen a rally year to date. As of yesterday, the ACWI ex-US is positive 8%, which is nice. Again, a nice recovery after that dismal quarter in the last 3-month period of '24. But I want to just graphically focus on this chart right here in the middle. The middle of the page directly beneath that pie chart. This is the effect of the US dollar, strong or weak, versus investing in the local markets. The purple row is the local currency, local markets. But take a look at the quarter, the QTR. You can barely see that sliver of purple. If I'm investing in the local currency, my return for the quarter is negative 0.6. Not great. But as I translate that into stronger dollars, that net negative 0.6% is now negative 8.1%. That's just the effect on the currency diversification, or in this period, that strong dollar. As I said, that's since reversed itself. But again, a very, very weak quarter given that surge in the dollar. Questions, comments? I go back to your point. Either I explained it perfectly or I lulled you to sleep. Please interrupt me as I go through. Next section, page 9. This is where a lot of data points are redundant and repetitive to John's. So I'll focus mostly on the middle left, the plan notes. In early January, thanks to a decision that the committee made last year, that Invesco Real Estate Fund was replaced by the DFA Real Estate Securities Fund. We are working on the Collective Investment Trust, or the CIT paperwork for the target date funds. And just real quick, and again, my biggest fear is talking beneath you, but also talking over you. Everyone knows what a target date funds is, especially when we were talking about it before on the agenda item, right? Or should I just briefly talk about a target date fund? Everyone knows what a target date fund is? Okay, perfect. From a governance standpoint, in spring of last year, we did update the investment policy statement. And then from a vendor management, anything worthy of note, we'll call that out, but as you can see, none at this time. There are a few funds that are giving us pause. You can see in the bottom third, the fund notes. MFS Midcap Growth. This is a fund that invests in mid-sized companies that exhibit more growth characteristics. So think technology, healthcare, energy, communications. That fund was placed on watch, given its focus on higher quality companies. When interest rates surged in 2022, a lot of these companies, their multiples got squeezed, their stocks fell, but this is a fund that we have no long-term concerns, and so our recommendation is to retain the watch status on MFS Midcap Growth. The next one is a different story. Vanguard International Value does focus on more of those international based companies, so like Brazil, Greece, Canada, Mexico. Does exhibit value characteristics, so given its core tilt, as well as a heavy allocation to cash, it's underperformed. Similar to MFS Growth, we don't have any long-term concerns with the portfolio, the personnel, or the strategy, and so our recommendation is to place that particular fund on watch. And then last one, again, in January, that Invesco Real Estate was replaced by that new fund DFA. The challenge is because this is as of December 31st, the data points in the report are still characteristic of Invesco Real Estate. From an investment standpoint, if you flip ahead to page 10, focus on the bottom half of that page and the navy blue columns. Some of my committees like to see how the investments performed, and so stripping everything else except for the weighted return of the underlying investments in the menu, you can see within the 457 plan for the quarter, flat to positive, 32 basis points. For the year, 13%. And then a little bit more muted over the longer term, 3 years, about 4.5%, and 7.5% annualized over 5 years. And then flip ahead to the actual menu. Very briefly, John covered this on pages 11 and 12. You can see all the funds on the menu in the 457 plan. We grouped them by asset class and then ranked them generally in risk order. So you have the more conservative fixed income funds up top, funds that invest in large, mid, and small size companies, those international companies, funds that I talked about. Fidelity International Index, that was added summer of 2024. You can see the middle line under the international header as about $500,000 in that. So not a lot of adoption, but still $500,000, nothing to sneeze at for this relatively new fund added, again, summer of 2024. And then under the asset allocation, ticking down from 11 to 12, those are those target date funds with the year or vintage in their name. And then the specialty Invesco and gold, real estate and Invesco Gold and Special Mineral. Flip ahead to page 15. This is the planned growth of the 457 over time. Way back in 2019, there was about $450 million in the program. It did hit this relatively high watermark in 21 at about 540 million. And then thanks to that dismal 22, where again, the ag was negative 13, the S&P 500 was off about 20%, about 465 million. And then thanks to those gains that John talked about 575 million. We've talked about this, I just want to call it out. On the bottom portion, you can see second line cash flow. We do track all the money going into the plan, so contributions, roll-ins, loan repayments, whatever it is, and all the money leaving. You can see from a year in, year out basis, the plan has exhibited net negative cash flow characteristics for every period. The number of participants, however, and again, I think it's in large part due to Nationwide, especially Brenda. You can see in 2019, 6,100 participants, eclipsing all the way up to 7,400 at the end of 2024. That's the second row from the bottom on page 15. So nice growth rate in participants contributing to the program. And then on page 16, this is that smaller 401A plan. You can see similar return characteristics on the bottom half of page 16, left-hand side for the quarter, about 0.5% to the positive, 16.5% for the year, and then 4.8 and 8.9% annualized numbers over the 3 and the 5 year. And then the plan growth on page 21, you can see the cash flow characteristics, obviously different demographic of participants, and so net positive. In other words, no parentheses on that cash flow year in and year out. And the number of participants staying relatively steady at about 100, 145 year in and year out. Flipping past the performance, not that it's unimportant, it's just because we talked about the two funds that are underperforming. I do want to focus on the next section, page 30. This is one of the fiduciary responsibilities that you and we have, essentially making sure that the menu structure, the investment performance, as well as the services and fees are reasonable. On page 30, you can see a number of different columns over the years. The components of the columns are made up of the fee structure that participants pay to invest in the plan. So that light blue portion is the fee that the investment managers collect indirectly. They're hidden in plain sight, but the expense ratios are disclosed, but most participants never really see it because the fund manager simply deducts her or his fee out of the performance. But you can see in 2019, the light blue portion was about 37.5 basis points. The latest period, 33.5 basis points. And so nice reduction, not huge, but a good trend nonetheless. The navy blue portion is what the plan collects for plan-related expenses. So this is what the budget is for, and the IRS really gives little guidance other than as long as the dollars benefit participants, it is a bona fide, legitimate, prudent expense that the county can use for the plan and/or its participants. And you can see it went from 3.9 down to 3.5, a reduction nonetheless. And then the revenue requirement is the orange portion. This is what the record keeper collects to administer, staff a call center, send out statements, et cetera. You can see it drop from 5.1 basis points to 2.25, rounded up to 2.3 basis points. And then very briefly, the accounting is on the next page, page 31. The menu is a little bit longer than one page, so it does tick down onto the top of page 32. But the second to right-hand column, those are those expense ratios that are fully disclosed, some would say hidden in plain sight. The fund manager collects each of these percentages before reporting the performance net of fees to you as participants. But you can see not only the second to right column, they're varied. Some are relatively high, some are relatively low. But that light blue portion, middle of page 32, this is the accounting. 33.8 basis points on a $573 million plan is just under $2 million annually. And then the accounting of that administrative cost is down below. The record keeper fee of 2.25 basis points is about $130,000 a year, $32,000 a quarter, or on the far right column, $17 per participant annually. And then the 3.5 basis points, again, this is for the plan-related budget, about $200,000 a year, $50,000 a quarter, or about $27 per participant. Vanguard, which is striving for low costs, recently announced a few days ago that they're going to lower the fee across their fund landscape by about $350 million a year. How that impacts the county's plan, it's only about $4,000 out of the $350 million. But on page 31, about 4 lines down, that Vanguard Total Bond Market Index Fund, that 4 basis point fee is now 3 basis points. So even though it's only a basis point reduction, some could argue it's a 25% reduction. About halfway down, you'll see the Vanguard International Value. Coincidentally, that's the fund that our recommendation is placed on watch. The expense is 36 basis points. They've reduced that by 3 to 33. And then last, the Vanguard International Growth has a fee of 25 basis points. Vanguard knocked that down by 1 basis point to 24. And again, across the plans, given the assets in the county's program, about $4,000 annual savings. I'll skip the 401A only because it's the same structure, no concerns, same reductions. But land on page 36, I talked about that plan-related budget, but that excess revenue that the county can use for plan participants. The previous sections were estimations. They're estimations because they were based on one and only one point in time, but the accounting of that administrative account is on page 36 down to the dollar. And so it's like an old school checking account or savings account. The ledger starts with the beginning balance, any contributions, any growth, any distributions, and the ending balance. So you as a committee and as plan administrator or anybody, for what it's worth, can see really to the dollar the accounting of that particular investment. And you can see at the end of the year, there was $240,000 in that account. Questions, comments on that section or this report? Did I explain that perfectly or lull them to sleep? What do you think?
I do have one question on the fee structure. If you could recall what page that was on, the fee structure for the deferred part.
The detail is on pages 31 and 32. The trend over time
Great.
is, yeah.
So for the nationwide fixed account, the expense ratio wouldn't, if that's that's where you park money to just let it sit, right? Why is that expense ratio there compared to other things that have a lot more, I would imagine, more involvement? Could that be explained?
Sure. So the footnote says that 40 basis point is a assumed estimation, if you will. So the general or fixed account is a spread product. It's like a savings account where essentially Nationwide collects all the premiums and then pays out the policies and then sits on many, many billions of dollars. What we have to do is simply report an expense, and through our RFPs where record keepers like Nationwide bid their proprietary fund in an open architecture, when we do the analysis, we come up with an estimate of a 40 basis point expense, even though that is just a highest group estimation, and it's merely that. And so it's really, you're not essentially paying the 40, you're getting the declared rate, but we have to come up with, well, we're encouraged to come up with something just for reporting, and that's the closest we use for other general account products of 40. Does that help?
I'm just not grasping. I would imagine that would be like the lowest one here, because it seems like if it's a savings account equivalent, it would be the least difficult to administer compared to, picking funds or tracking indexes or something. So maybe I'm not understanding.
Sure. You're absolutely right, there is never a fee that Nationwide gives us, unlike any other option, that the expense ratio to manage their general account is 40 basis points. We are merely estimating that because of the difference in pricing of a proprietary bid using that fund versus not using the fund. And so it's merely an estimation just so we can come up with a weighted average for the plan, but it's not explicit to us. And so I don't know what the fee is. I agree with you. I think it's probably fairly inexpensive to manage that portfolio, but we don't know. It's not disclosed. I don't know, John, if you have any comments about the expense or if we're close or.
Yeah, we don't know. It's not disclosed to us either. So the fixed fund, again, it's a spread product. So let's say we're paying 2.5, we might make 2.9 or 3, and then we pay the net to participants. So it's not like a regular mutual fund where there's a declared expense ratio, and it changes over time with us internally. So it's not the same. It doesn't act or talk the same. So highest just kind of assumes that maybe that's our margin, right, of 40 on top of what we're paying, and then we would then keep the 40 for administering that fixed option. So that's sort of what that 40 is. It's kind of like our margin internally. Yeah, because it doesn't have an expense ratio like a regular fund. It's not traded daily like a mutual fund. It's just basically it's a giant bond portfolio worth about close to $50 billion in assets, and it's invested in hundreds and hundreds of bonds, and it's a very large proprietary stable value type product that we manage for many different clients, not just the county, but thousands of clients. And it's all just one giant portfolio with a spread and kind of an earnings that we keep, and then we pay the difference for the net rate, if that helps. It's similar to like a bank, right, where you might make 2% in interest, and maybe they make 3% and pay you 2%, right? They don't really disclose kind of what their spread or margin is. So there's an estimate margin that we're sort of keeping as a company. I hope it helps.
Yeah, much better way of explaining that. Thank you.
Clearer than it was. Thank you.
Yeah, thank you.
Yeah. But there is no risk there. So if you wanted to get out of the market, didn't want the ups and downs of the stocks or bond market, that's where you go. And it's also liquid, so you can go there, and if a month later you change your mind, you can go out to something else. Except the money market, there's an equity wash there, but you can't jump from money market to fixed. But it's a place to park it for a while until you're ready to invest. So maybe you've locked in a bunch of earnings and the market goes and then, trying to time it. So that's a place to go, and also money market, but it's no risk there. It's one of the few places that you can go without any sort of volatility.
The one thing, and again, John, very well said, during the credit crisis, though, when John talks about no risk, I do want to be clear, because I think what you're saying is there's no market risk. During the credit crisis with the previous record keeper, a lot of these assets in these types of accounts sit on the issuer's balance sheet. And so essentially there is some risk at the single issuer, most notably the insurance company. And essentially it was a lot of phone calls not tied to the market volatility. It was the viability of the insurance companies who are able to basically backstop their commitments on these types of products. And so there's no market risk, but there is a little bit more incremental risk in terms of the people guaranteeing that rate. Other questions, comments on that report? Okay. And then I'll defer to you. Is now a good time to address the watch fund, that
Yeah, I was
Vanguard
just gonna say
International Fund? Okay.
We can do that now. On the agenda, there is the request to place the Vanguard International Value Fund on watch. We have a motion from the advisory committee.
I'd make a motion. I don't think any of our international funds have been doing great for a long time.
I'll second.
So we have a first and a second. All in favor, say aye.
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 Opposed? Motion carries 5-0. And then I think we wanted to do a review of the target date. Is that correct?
Yeah, just 1 second, I'm jotting.
Okay.
Okay. Yes, the next highest group report is titled the Target Date Manager Review. This is something that we do on a regular course, not because there's anything necessarily wrong with the current target date provider, which is T. Rowe Price. If you recall, the legal standard or the responsibility for us as fiduciaries in the state of California is not necessarily the outcome, it's the process. And so if I forecast into a couple months, a couple years, a decade or more, if there ever is a challenge, a participant looks to the county highest group through a lawsuit or an investigation, whatever, really they're going to look at the process, not necessarily the outcome. Now, granted, the wisdom is if you have good outcomes, probably not going to be sued, but the legal standard is around the process. So once in a while, we do a lot of these practices just so we have it for the file, so that you can say, yeah, way back in 2025, we did look at the target date funds and looked at possibly replacing them. The majority of my clients who go through this don't switch, but who knows? You could look at another provider of target date funds and say there might be a more appropriate one for the participants. It has happened. And so again, there's nothing urgent, there's nothing wrong with T. Rowe Price, but you may feel differently at the end of the agenda item. So we already talked about the target date funds and what they are. There are about 45 target date providers. We are including 4, certainly State Street that was mentioned before, but in addition to the incumbent that you have T. Rowe Price, we have American Funds, BlackRock, and Vanguard. If you flip ahead, there are a few charts that really drive the discussion. On page 5, this is in the top 3. On page 5 is what we call this equity glide path. And true to form, these dynamic target date funds are more aggressive in the longer durated vintages. In other words, the 2050, the 2060, the 2070, there's a lot more exposure to the stock market because the wisdom is younger participants can ride out and generally have a higher risk tolerance to the volatility. But because retirement is so far away, they have enough time to recoup any losses. You can see different colored lines, and this is the glide path or slope. 35 years to retirement, all the way through retirement to -5, and I'm on the horizontal axis. and then the percent of equity is on the vertical axis. The incumbent, T. Rowe Price, is the yellow line. Anyone notice an outlier? They're a little bit more aggressive than not only the average, but then the three that we're comparing T. Rowe Price to. The green line, you can kind of see, is the American funds. BlackRock is the navy blue line. The light blue line is Vanguard, and the dotted line is the category average. And you can see on the longer durated, short of T. Rowe Price, or the yellow line, or the incumbent, there is a tight grouping. There's a little bit of dispersion about 15 years out. You can see American funds is still a little bit more aggressive than the average or the other two, but there is a little bit more grouping as the vintages get more and more conservative. But this is generally the main topic of discussion when we talk about the composure of the target date funds. Any questions, comments? Okay, turn to pages 7 and 8. If you want to get a little bit more detailed in the makeup of the stock market, because as I said, there is a US stock market and an international component of the stock market. You can see the split between the light blue and the green of each of the providers. So it's not just one stock market. If you had any feel on, well, what is the allocation versus the US compared to the international? We also do the same with the bond market. The US bond market is the gray component, the navy blue is the international bond market. And then the cash is that yellow portion, and then others, which is typically derivatives or convertibles. And then on page 10, this is where we do distinguish between a somewhat, some would say traditional, some would say antiquated view of the world. There is a breakdown between developed markets like Western Europe and Japan and the emerging markets like Brazil, China, Russia, et cetera. So you can see in the bottom row, second from the bottom, the amount dedicated to the emerging markets compared to the developed, which is right above it. One of the outliers is BlackRock at 13%. You can see Vanguard has about an 8% exposure to the emerging markets on the stock side. T. Rowe, only 5%, and then the lowest is American funds at 4%. Just something to call out in terms of dedication to the developed versus the developing or emerging markets. And then similar on pages 11 and 12, you can see the fixed income composition. A lot of different types of bonds. There's the inflation protected, like a treasury inflation protected security. There's agency mortgage-backed securities, so like Fannie Mae, Freddie Mac, non-agency mortgage-backed securities, commercially mortgage-backed securities, asset-backed like loans for cars, credit cards. But you can see the details across the fixed income category as opposed to just one component of bonds. And then on page 13, this is the credit quality in terms of the fixed income allocation. And you can see, similar to students, the very, very high quality or A or AAA, and then as the credit quality dips down into B, C, or what we call junk or high yield, you can see American funds towards the bottom has an 8% exposure to junk bonds. T. Rowe Price, a little bit more aggressive at 9%, and then BlackRock, 5%, and then Vanguard, only 1%. And then on page 14, this is probably the second in the top 3 charts that people focus on. This is the expense. So T. Rowe Price is the incumbent, that's that yellow. You can see the weighted average is 42 basis points, followed by 36 basis points on the American funds, which is the green or the first column. BlackRock, a close third at 34 basis points, and then Vanguard, because they're passively managed, 8 basis points. And then the next section is the performance of the different vintages. And so on pages 15 and then throughout, each vintage has its own page. And so the most conservative, retirement, or balanced is listed on page 15. Each colored row, or maybe primary colored row, is a fund provider and the performance net of fees over different time periods. So you see the short term for the quarter, all the way out to the 10-year. And then moving from kind of middle to far right, you can see calendar year returns of these different portfolios. Directly beneath is the performance of the index, but I think it's even more telling is the third line, which is plus minus index. We're looking for numbers that beat the benchmark. If it didn't beat the benchmark, it's gonna have the parentheses in it. So the parentheses are less than ideal than no parentheses. But equally important is the grayed out rows. These are the peer group rankings expressed as percentiles. And so these numbers will always be from 1 to 100, where numbers closer to 1 are better than numbers closer to 100. And so you can see some very, very solid performance on pages 15, 16, and throughout. But back to my point about the Vanguard, because these are passively managed funds, they're not designed to beat the benchmark. They're merely designed to track the benchmark at a cost that's really, really, really low compared to the other three. And so you'll see some muted performance for the Vanguard, but some people love Vanguard because of the low cost and because, to a certain extent, less volatility, especially with the T. Rowe Price, because you have that higher equity allocation, longer and shorter durated. But the nice thing is, as you tick into deeper in the book, you'll see a lot of low numbers for some of these providers compared to Vanguard. But again, focusing on T. Rowe, good performance, unless, given everything else, you see a more appropriate target date provider. Any thoughts? Any questions? Then I'll put Brendan on the spot. Have you heard any feedback on the target date provider, performance, fees? No? Okay.
It seems typically slightly higher fees with what we have. However, performance-wise, I think it's doing excellent. So to me, right now, just on the, I studied this when we emailed it, but then also today, it still looks solid performer.
We talked about using the corporate investment trust share class of this, just to kind of like take it down a notch or two on the expense ratio, so that's nice.
Mm-hmm.
There was some hesitation about that, but saving, right?
Yeah.
So, any advisory committee members want to take any action at this point, or are we okay with maintaining T. Rowe Price?
I'm good with what we got.
Okay.
I concur.
Okay. Thank you.
Good, thank you.
Okay. So next on the agenda, I have review nationwide annuity-like products.
So this will be 11 seconds, if that. As a
Okay.
result of the last meeting, when the question was raised about, okay, this may be a great product, but are there others? One of the tasks that was assigned to Highest Group was to create this grid to comparing that. So given the discussion earlier, this is moot, education or informational only. So take a look at your leisure, but very much moot. So
guess maybe we should have moved that earlier on the agenda, I'm sorry.
Again, Nationwide always does a good job explaining things very
With,
well, so.
with your research, do you have any concerns about our earlier decision?
In generally, no, but as a consultant, I always worry. So, sorry, you asked about concerns. Yes, but we've talked about them. The portability gives me a little bit of unease, but it's totally surmountable. The other nice thing, and as a consultant, I will probably over-answer, the really, really nice thing from a fiduciary standpoint is given Secure Act that was mentioned earlier, with the plans that we do have, we collectively don't have to be an insurance company expert. There is this short checklist that we do annually with those other committees that, given the broad fiduciary relief, we'll just agendize this once there's assets in this and it becomes a responsibility. So that is a huge, no pun intended, checklist to say, given the checklist that we'll do on an annual basis, tremendous amount of fiduciary relief or inoculation against lawsuits. So no, I don't have huge concerns, but the small one I do have is surmountable.
All right, before I forget, I do want to move back to the agenda to the minutes. So staff has distributed the minutes. If there's any questions about the minutes, or if I can have a motion to approve the minutes from October 24th. So, council, I think the question is about members who were not at the meeting on the 24th.
I'm sorry, what's the question?
So I think we have several members who were not present at the meeting on the 24th.
And they want to know whether or not they can vote on the minutes?
Yes.
That's your decision. You can always, you have them, so you can read them and determine whether or not you want to approve them.
I was in attendance and we were all able to read it via email early, and so I'll make a motion to accept as written.
And I will make the motion to second it since I was the other member present. All in favor, say aye.
Aye.
Opposed? And any abstain? Okay. Motion carries. Thank you. All right. Okay, we did want to mention, for everybody's awareness, the NAGDA conference, which those who attended last year, I think we had a great education and really enjoyed it. So I would recommend for everybody to review their calendars and determine if it's something you can participate in this year. It's September 28th to October 1st, and it will be in San Diego. I know that our treasurer tax collector has already indicated that he would be, is intending to attend. So I don't know if anyone else has. Yes. So the Deferred Comp Advisory Committee is able to attend, and the expense comes from the administrative fees for the deferred comp. So it doesn't hit the HR budget. So we do, yeah, anyone's budget. So it is part of the plan expense to ensure that our advisory committee members are educated on this. And I have found it, I've gone twice, very, very educational. So we do encourage you to participate, and it would be paid out of the fund. It doesn't hit anybody's individual departments.
I'll follow up with the schedule check, if that's okay, and follow up with it via email.
Absolutely. All right, and I'll ask staff to make sure we get an email out to everybody just to pull interest and make sure we're tracking, to make sure that we get people registered as soon as possible. All right, we had on the last agenda in October a debrief from NAGDA, and then we didn't have everyone present, so we just wanted to bring this back in case there was any other initiatives or discussions that people wanted to make. I know that a couple of the things that we talked about were consideration for pursuing with our bargaining groups, the auto enrollment. So that there was a lot of discussion about that in NAGDA, and I know looking at, from my perspective, and then I'll open up to the committee members, but as we do look at people moving forward and making sure that they do have all the tools they need for a secure retirement, I think the auto enrollment is a tool to drive up the participation. And today, seeing the, the range, the age range of people, it would be great to get people into the plan younger. And I do think that auto enrollment would assist with that. So that's something that I would recommend that we consider trying to pursue. And that was one of the takeaways that I did have from the NAGDA conference. I don't know if there's any other things. Jason and Sandy were both in attendance.
Great training, loved it. I learned so much, and I think a lot of the award-winning, plans in terms of participation rates and growth rates and contribution rates, one common denominator they all had was the auto-enrollment, and they would auto-enroll everybody, kind of like we do open enrollment in May for our benefits, and if you don't like it, you have to march down here and unenroll, and they did find that after a few auto-enrollments, people just give up trying to not save for retirement, so that's been positive.
I will note that that is something we have to pursue with our bargaining groups. It's not something we can require. We have to negotiate that. So I think that's something that the Labor Committee can work with the board to discuss, that some strategies we could use as we negotiate of how we can gain that agreement from the groups for the auto enrollment that I think are definitely, I would hope the bargaining units would see it as a real positive move.
Yes, I would agree with that. I thought the sessions were great. They were very informative. If you can, Supervisor, I would recommend that you attend. I thought the participation was great. And just to hear what all the other cities and counties and different agencies are doing, and one, I would agree as well. The auto enrollment was a common theme there. If we could really get that boosted up. And, I think once we go into bargaining, that might be something that we can, to be creative and what we can do with that, but what else we could do for the employees.
All right. Is there anything else that the group wanted to talk about from the administrative bylaws? There's probably more work for the HR team working with Vincent on, but making sure that, we realized from administrative standpoint that as we moved record keepers, some of the documentation about the advisory committee and its procedures kind of dropped off. And so we want to make sure that we get those, kind of firmed up, and so that we're all, this committee can be as effective as it can be. So that's another piece. All right. Any other comments from the committee members about NAGDA or any other topic?
I wanted to welcome Supervisor Gardia to the committee. Although, I can say you're an improvement from Paul, so.
I will not.
I will not.
All right, our next meeting is Thursday, May 29th, 2025 at 10 a.m. And nothing else, we'll adjourn the meeting. Thank you.
Thank you, everybody, appreciate it.